Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, here's an excellent example of one recent currency that did just that. Here's our dollar versus the new Swiss franc. This is a new one. And we had a trading range here for a period of time with an explosive move from about 102 to almost 106. Okay, that is a huge move. However, you'll notice I put this little trend line across here. A week after the move happened, we actually stopped and made a low on this weekly candle, and we tested that low the following week. Well, folks, at that point in time, the following week, we busted right through that low, and anybody who took this breakout trade, if you didn't cut the trade off at some point in here, you ended up pulling back all the way to where the breakout happened. So you didn't ring the cash register, no gain. Okay? So have a plan for taking an exit. I did not draw Fibonacci tools on this particular chart. I can talk to you more about that sometime too, and possibly in a future webinar if there's some interest in that. But multiple strategies, folks. So there's also another way that you could re-enter that, which we're going to talk about, called a possible pullback entry. Okay. In uptrends and downtrends, you're often going to hear the phrase, in a rally, buy the dips, and in a decline, short the rallies. Okay, so you can buy a pullback to breakout points, which is known as buying the dips. As you can see on this chart here, here's a breakout that tested 100% of the move back to where the breakout began. Now, here's the thing. We had some resistance here. Old resistance generally becomes new support. This is a second bite of the apple for possibly a new uptrend. Okay, you can buy pullbacks to uptrend lines if you're drawing your vertical trend lines, okay? And you can sell short pullbacks to downtrend lines if you're drawing your vertical trend lines to keep you on the right side of the trend. How many times are you going to hear it, folks? Trend is your friend, okay? When there is a trend, make sure that you're drawing your trend lines, okay? Here is the yuck. A recent picture of the yuck. At the time I took this picture, though, it was the beginning of July. So since I'm doing this on weekly charts, I'm pretty much planning out my month of July based on the picture that it's presented to me at the time that I draw my charts. Okay, so I have this ascending triangle. And we're going to talk about chart patterns, and this one I did draw the trend line on there. We did have a successful breakout of the ascending triangle. We also had a pullback to where the breakout happened shortly thereafter. So again, the guy who took this risk on this breakout of this ascending triangle, at some point between here and where the retest is, you got to take some profits. Okay, you took the risk, take some profits. Okay, on a pullback to a breakout point, exit the trade if the price trades below the lowest low of the consolidation area. So on that previous chart here, if I were to buy a pullback right here to this horizontal trend line across the top of this ascending triangle, I would have to plan to place my stop loss right below these lows of the congestion area prior to that breakout candle. Okay, that's called a technical stop. It's a logical place to place the stop. There should be some support here. However, if we do trade down, there's a possibility we could make new lows, and I won't want to be long if that were to happen. Okay, on a rally up to a breakdown point, you can exit the trade if the price trades above the highest high of the consolidation area. Okay, again, if we're making new highs and I'm short, not a good trade. Okay, time to close it up. You can exit if a price closes on the left side of a trend line. We like to teach people in on the right, out on the left. And of course, I can also use a moving average as another idea for a trailing stop. Okay, so these are possible exits for pullback entries. Okay. Now let's combine some range and trend trading ideas and incorporate some trading tools called indicators. In markets that are in trading ranges, take advantage of buying low and selling high using oscillators. CCI, for example, Commodity Channel Index, Relative Strength, or RSI, or a stochastic oscillator. They tell you when you're overbought. They tell you when you're oversold. If you've got a high and a low of resistance and support, then what you've got is a trading range, and these indicators are correct. When you break out into a trading range and you go into a trend move, you must ignore oscillators, okay? You also can plan out your breakout entries, which means you're going to buy high and sell higher if you take a breakout of the top of the range, or you're going to sell low and buy back lower if you break out of the bottom of the range. You can use entries in some markets. The nice thing about using options is you know your risk, you're defining your risk, you're never going to risk more, okay? So options are a great strategy for when you do finally break out of these trading ranges. If you get a trending market, I have indicators that will help you stay in the trend. An ADX indicator will measure the strength of the trend. The ADX indicator only measures strength. It does not tell you direction, so you have to learn how to use this indicator properly. And when it's rising and going up above 40 or so, it indicates your trend may be possibly looking to rest or reverse. Okay, so you have to learn how to use those indicators correctly. Another one I like to teach is the moving average convergence divergence, because it does give you a little bit of the overbought, oversold, and at the same time it measures the strength of a trend by measuring the vertical distance between a couple of moving averages. So right tool for the right market. Okay. Here we have little bounces using the RSI as an example, again using our euro versus the dollar. Okay. So a couple of times where we did trade in little ranges here, RSIs gave signals to actually take bounces at the bottom of the range. You'll notice though this particular indicator never really, with the settings it had, got to the overbought condition, okay, to indicate a place to jump in short. So this indicator was good for keeping us in the range while it was in the range, and unfortunately it wasn't the indicator that got us into the short positions, okay? A CCI, a Commodity Channel Index, which most students that I teach know I like the best, that one has the ability to go extremely overbought and extremely oversold. And next time we do that, I'll spend a little bit more time. I spent some time on the first webinar using that indicator, so I wanted to switch it up a little bit and show you a different one here. Okay? But even here, you see where your relative strength in around April or so, this last one on the chart, it actually gave you the signal to take an entry here near 62.50 on the euro versus the dollar versus the euro. Okay, and you'll see we're still trading in this range. Okay. Also, looking at this chart over here, some ideas again. Buying 62.50 calls at the bottom of the range. There's a chance here when I see this picture, when I'm planning this webinar out, that I could have a double bottom. Okay. I'm looking for a stage 2 breakout again. If I get a bust out through the top here, this moving average has just reached this trading range over here. That's one of the things I need to see. Another strategy, again, if it stays in this range for a period of time, use advanced option strategies to collect premium while it's in here. Okay. Remember, this was the all-time low for the dollar versus the euro not too long ago. We'll see what it looks like in a little bit here. We're going to do some live charts shortly. Again, here's a dip to a trend line using the yen, okay, or the yuck. And again, you can see on the bottom of the chart here, I have a rising ADX during a downtrend. This is what this indicator is going to do. It's going to rise to indicate the strength of your downtrend is strong. And notice you see the indicator rolling over, heading back down towards the low. So what you would need to see to confirm this uptrend, you would need to see this indicator again switch over and rise above 40 to indicate that the new uptrend is gaining strength. At this point in time, that indicator was telling you, yes, we're rising, but there's no strength to this possible new uptrend. Okay, so another good thing about these indicators is they can help you kind of gauge the strength of a move, especially in a market where there's very little volume.
Thank you for listening to our podcast. Please visit www.ise.com/podcasts.